Hello, everybody. My apologies for being late. I had trouble signing in.
No worries. Hi, Giles.
Hello, Booja. How are you?
I'm fine, thank you.
Great. So we have many students arriving, which is excellent news.
Yes, and more are coming.
Very good. I'm looking forward to our session. I've been looking forward to this very much.
Thanks. First of all, thank you for joining the session and giving us this opportunity.
Oh, no, you're very welcome.
So let me introduce you very shortly. Yes. So thanks everyone for the session. Today we are hosting Giles Coghlan as a guest speaker. He is based in the UK and he's the Chief Currency Analyst at HYCM. It is a well-established multi-regulated global forex broker. He will talk today about the impact of COVID-19 on financial markets, particularly to commodities, FX, and stock markets. It's a very hot topic at the moment, and we are really wondering the speech. Please free to join and ask your questions. I hope you will enjoy the session. Thanks, Giles, again.
Oh, you're very welcome. Now, I'm just going to make sure I get my screens all set up correctly. I apologize. I had some slight problems signing in, so I just want to make sure I'm showing you all the right screens. There we go.
No problem.
Now, you should be able to see a screen that says HYCM, COVID-19's impact on the financial markets.
Yeah, we can see.
That's great. Well, first of all, let me say a very good afternoon to you over in Dubai. I hope the weather is a lot warmer than it is over here in the UK at the moment. It's one of the bad things about living in the UK is we never get the sunshine. And I know it's always sunny in Dubai, so I hope you give some of the sunshine over to me. I'm looking forward to taking us through this session. And the idea of this session is that it's going to be interactive. So I will be giving you opportunities to answer questions during the session. So if you don't know how to unmute yourself, just familiarize yourself with the unmute and the mute function so you can use it when it comes to asking the questions during the session. I'll just introduce myself a little bit more. I've had over sort of 10 years experience in technical and fundamental analysis of the FX indices and commodities markets. And my background is one coming from a practical trading background. So I've been immersed in the markets every single day of the COVID-19 crisis. So I've been looking at the moves across all different financial instruments. And my role as HYCM's currency analyst is to show clients and explain to clients the reason for these moves. I also do private coaching. I have a background in hedge fund trading, and I work for a number of different clients, mainly around advising people and showing people the reasons for market moves. So that's my background. I'm also an analyst that regularly gets asked for comment on market moves. Is it a central bank interest rate move? Is it the US elections coming up? I'm due to speak on CNBC Arabia immediately after this session that I'm doing with you today. So you will see me here and there. You may, if you watch CNBC Arabia, I will be on immediately after this session. I'm featured in the UK national press, The Guardian, Financial Times, Business Insider, Wall Street Journal, City AM, and many more. And I contribute daily to Forex Live. So my background is completely and utterly immersed in the markets. It's what I live and what I breathe. So the reason I'm telling you all this is I hope that you understand my perspective and that it will give an interesting perspective to your learning and to everything that you're learning with your professor about the financial markets. So feel free to ask questions during the time, and I really look forward to engaging with you, more personally as we go through the session. The agenda is very clear today. We're going to look at the impact of COVID-19 in the FX, bond markets, commodity markets, and the major global indices. Now, we're going to deal with each of these in turn. So we're going to deal with the FX markets and bond markets. And because of the close correlation with interest rates and FX markets and the bond markets, I'm going to deal with those two together. And then we'll look at commodity markets and the major global indices. So I will roughly spend, a third of the time on each of those major categories. And that's how I'm going to break down the session. So if that's clear, I'll press on. So obviously we're living in very unprecedented times. None of us here have lived through a global pandemic. And none of us want to live through a global pandemic again. I'm absolutely sure of that. And the impact on the financial markets has been extreme. So it's a really interesting study on market dynamics and human behavior as we see what's been happening during the COVID-19 crisis. So the first major impact that we see in the FX space, would anyone like to guess which currency do you think has seen the biggest impact in FX markets? I'll ask that question to any student who feels brave enough to answer. Which currency do you think we've seen the FX have the biggest impact on? Does anyone would like to have a guess?
The US dollar.
Oh, well done. Who said that?
Me, Morris.
Morris, gold star for you. Exactly. The US dollar has been the biggest mover in the FX world. Now, if we just go to the dollar index, I'm just going to show that to you. We'll just look at the charts here. Now, if we look at the path of the US dollar, we can see that as the crisis really got underway at the start of the year, just heading into February and March, we saw this huge rise in the US dollar. Now, the reason for that strong demand in the US dollar is, as many of you will be aware, many countries' debt is denominated in US dollars, and it is the global reserve currency. So what this means that in times of crisis, markets and central banks around the world were scrabbling for US dollars. It's simply because in these times of crisis, one of the characteristics of the US dollar is it operates as what's known as a safe haven currency. And the first impact we saw was this heavy, strong dollar buying because of the strong demand for the US dollar. And as some of you may be aware, the demand became so strong that the Federal Reserve had to set up some extra swap lines for major central banks around the world in order to give them enough US dollars to meet demand. Now, one of the privileges of the US is that in times of crisis, everyone wants the US dollar. And they also get to decide who does get the US dollar and also who doesn't get. So they have this incredibly privileged position, and similar to the global financial crisis, when markets are very, very worried, we actually see the US dollar appreciating. So that was the first and the strongest impact that we saw in the markets on that US dollar strength. Now, for myself as a currency trader, these were a couple of positions that I took in March. So in March, I could see the strong demand coming in for the US dollar. Knowing the fundamental reasons for that demand, it made sense to buy the dollar. So this is the dollar index, and I took a couple of positions long at 51 points, 270 points, and I left a final position running at break even, trying to take advantage of that strong dollar demand that we saw coming into the markets. And obviously the US dollar, part of the reasons for the US dollar, and you will have to forgive me if I'm telling you things that you already know, so please excuse me if I do that. But obviously the US, around a quarter of the whole world's GDP comes from the US. So between US and China, about 40% of the whole world's GDP comes from these two nations alone. So you can see the dollar-centric nature of the FX world. So that really came to the fore in the heart of the crisis. So the first thing to be aware of, in the times of COVID-19 crisis, there was a strong demand for the US dollar. Now, that demand didn't last. It helps me to get a sense of your understanding as well. Why did that strong dollar demand, why did that not last? Does anyone know why the dollar started selling off?
Poor performance when it comes to the maneuvering with the whole COVID-19 situation.
That's a good answer, and that is part of the answer. Yes, very good. But there's a couple of strong reasons.
If everyone has dollar, then that means that the dollar is going to lose value very soon. So they're trying to sell that very quickly, potentially.
That's a good guess, and I like your thinking. I'll give you a couple of reasons. First of all, there was large quantitative easing happening by the Federal Reserve. So lots of digital money was being produced into the system, and that weakens the US dollar. We also had the Federal Reserve cutting interest rates. So,
but what? Sorry?
No, carry on.
No, because I was thinking maybe it has the fact that they started giving out those stimulus stuff to the people. I think it was $2 trillion. That was the first time. And then I think it was they were talking about second time. And I'm not entirely sure if they did it the second time as well. That might have had an impact as well.
Yes. Alex, Alex, you're right.
Basically.
Yeah, it does have an impact, and all that weakened the dollar demand because there was enough supply. So people weren't scrabbling around for the US dollar, and the fact that the interest rates were being cut was the fact that the demand for dollar was just decreasing. So that's why we've seen, and that's why the dollar at the moment is in a current downtrend, because the expectations of the interest rates are going to remain low. There's large quantitative easing packages that are still into play. The US stimulus package needs to be agreed by the Senate at the moment, should happen after the US elections. All of that puts a downward trajectory on the US dollar. So we started looking at the COVID-19, and it made sense to start with the dollar because the whole FX world is dollar denominated. It's a dollar-centric universe for us in the FX world, and around 70% of all currency transactions every day involve the US dollar. So that obviously has a strong impact on the other currency pairs. So the major currency pairs, the Aussie US dollar, the Euro US dollar, the Pound US dollar, New Zealand US dollar, and the US Canadian dollar are all heavily impacted by the dollar index. So here you can see in my trading platform, when I'm looking at the currency markets on a day-to-day basis, I'm referencing the dollar index down here on the right, and then I'm also using the major currency pairs. And the dollar is my barometer to how the other major currency pairs are going to perform. Now, here's a question for you. If during the crisis we had the dollar index rising, what would we expect to see with the Euro US dollar currency pair? Would we expect it to see it falling, rising, or doing the same?
They would end up falling.
Yes, it would end up falling. Now, the Euro-US dollar pair is the most widely traded currency pair in the world. It's the most liquid market, and it's the one that traders will pay some of the least fees for accessing the market. The other nickname for the Euro-US dollar pair that I use is the anti-dollar index. So what you find is the Euro-US dollar does exactly the opposite to what the dollar index does. So with the behavior of the dollar index, we would expect to see the exact opposite in the Euro-US dollar pair. And if you just look on the chart, you can see the turquoise line is the dollar index, which we were looking at earlier. We can see the candlestick chart is the Euro-US dollar currency pair. So in the heart of the crisis, when there was that strong demand for the US dollar and market participants were worried about getting access to the dollar, we saw a sudden sharp move down in the euro US dollar. And as the liquidity concerns have been alleviated, as the dollar has flooded the market, as the Federal Reserve sends dollars around the whole world, we see the dollar index weakening and we see the euro US dollar picking up. So one of the reactions that we've seen during the financial crisis is this pickup in the euro US dollar. And that is simply because the dollar index is known as the anti-euro US dollar index, or the euro US dollar is known as the anti-dollar index. They're a good kind of comparison to one another. And that's mainly because if you think about the trading blocks around the world, you've got three main trading blocks that are most significant. So you've got the US, you've got Europe, and you have China. And those three trading blocks are, you know, some of the most influential trading blocks in the world. So here with the euro US dollar pair, you've essentially got the US trading block versus the European trading block. The dollar index has a weighting of over 50% of the euro in calculating how the dollar index works, which is why you see this inverse relationship. So during the COVID-19 crisis, we've seen the dollar instantly rise and then drop due to quantitative easing stimulus package. We've seen the euro US dollar fall and then rise in sympathy with a falling dollar index. So that's another key currency move that we've been seeing. Just as an aside, we've also seen some upside in the pound. Now, what is the main driver of the pound at the moment, and what has the pound been dealing with as well as COVID-19?
Brexit.
Yeah, we can't have a seminar without mentioning Brexit, can we? Exactly.
Oh,
and the pound has been rising quite considerably since the crisis, and that has been on two factors. It's been one, on the dollar weakness. So with the dollar being weak, that gives the pound support. And also the pound is supported on this notion that eventually the EU and the UK will reach a trade deal. We are eternally optimistic in the markets at the moment that a trade deal will be done, because it seemed to be too catastrophic for both EU and the UK for this trade deal not to be done. So that's why we've seen the pound being supported during the session as well. Now, here's a question for you. What if the US dollar acts as a safe haven currency, a currency that people rush to in times of a crisis, what are the other major two safe haven currencies that we see in the markets?
The yen.
The yen, exactly. And that's another big mover. Now I'm going to go to the cross pairs. I'm not going to look at the US dollar Swiss franc and the US dollar Japanese yen pairs, because all three of these currencies during the COVID-19 crisis have been acting as safe havens. So we've seen range-bound action in these major currency pairs that are paired with one another. So we're going to go to look at a cross. We're going to look at one of the cross pairs, and we're looking at the Aussie yen cross pair. So I'll just call that up. Right. So you can see here, this is a weekly chart of the Aussie yen. Now, in times of financial crisis, FX traders, investors around the world like to park their money in places where they consider the money to be safe. The Japanese yen is one such currency. So in the times of crisis, we expect to see strong yen buying. Now, we did see strong yen buying in the middle of the crisis. So you can see here, as the crisis is taking root, as markets around the world are understanding and expecting that the yen is going to be bought, that the COVID-19 cases is turning into a global pandemic. It was around this time the World Health Organization declared a global pandemic was underway. And so we saw strong yen buying. Now, what you might be surprised at is how brief that yen buying was. Do you see that this yen buying really took place in about a month. So over about 3 or 4 weeks, we saw this strong yen buying. Now, the reason I've chosen the Australian-Japanese yen pair is there's a reason I've chosen this pair. Why might I have chosen this pair to demonstrate yen strength?
I think Australia did quite well initially with the cases, maybe.
But you're absolutely right, and that is a good observation. Let me give you the answer. We will get onto that, and that is a good observation. The Australian dollar Japanese yen pair is kind of seen as the currency pair that tells you how the globe is feeling about risk and about trade. So if the market is feeling optimistic, you tend to see the Aussie yen gaining. If the market is feeling pessimistic, you see Aussie yen falling. So you can see in the heart of the crisis, you saw this very, very heavy yen buying. This was a very pessimistic market. So what it might surprise you to see that actually was quite a brief move lower in the yen, wasn't it? Considering how much impact there has been in COVID-19, why do you think investors and traders reversed this position so quickly?
I think because the borders closed quickly in Australia and trade would have stopped in that instance because of Corona.
Yes, you're absolutely right. Australia and New Zealand were two of the quickest countries to contain the rise and the spread of COVID-19. And there was definitely some strength that came into the Australian dollar and the New Zealand dollar as a direct result of that. You're absolutely right. Why do you think the yen was also finding a little bit of weakness as well? Think of the nature of the crisis. What was the difference between this crisis and the COVID-19 and the global financial crisis? What's the main difference? Think of global financial crisis, 2008, 2009, and this
2008 was subprime, so it was a monetary crisis. Well, this wasn't a monetary crisis. This was another. The nature of it was completely different.
Exactly. So 2008, 2000 was a financial crisis. This was mainly a medical crisis, and therefore it was going to be a medical solution that was going to lead the way through. Now there was also, I remember reading at the time, a lot of, I'll show you the image that I got. I remember reading at the time, there was a lot of reports on what happens during times of global pandemics. And this was roughly what happened in the global pandemic of the Spanish flu. So we had a lot of analysts were seeing a lot of comparisons. And I remember speaking to a journalist at the Financial Times, and she was telling me that pandemics tend to last like 2 to 5 years. They're not one-hit wonders. They tend to sort of bobble along. And this is what happened at 1918, 1919. You can see we had this second spike, which doesn't that look familiar to what we're seeing now? You know, given the fact that this was the first spike in 1918, then the second spike that was more virulent, that's pretty much exactly what we're seeing now. And that was what the CDC actually predicted way back in sort of early, around March, April, May time. They were expecting this second spike in COVID-19 cases, which is pretty much what's happened. But also we've had considerable progress being made on vaccines. So the reasons for this, a lot of analysts were talking at the time, is will we see a V-shaped recovery? This idea that the markets drop quickly and rise quickly. And so some of that was correctly on the fact that New Zealand and Australia, both of them managed to lock their borders down quickly. But it was also due to this expectations that a vaccine would be found, that this was a medical problem and a medical solution would be found. So a lot of that has been and is still influencing the markets now, as expectations are that a vaccine will be found, is essentially the expectations that the markets are trading in. Okay, so that's some of the major currency moves. Are there any questions you have about major currency moves during the crisis? Anything that you're not sure of, or we'll look at some central banks moves in a minute. But I just wanted to check with you in terms of the actual currency.
I mean, gold bars aren't a currency per se, but they are considered a safe haven. So what were the movements of the gold bars?
Oh, that's a good one. Now, gold was tricky during this time for a number of people, and they got caught out because gold does operate as a safe haven. But what's the biggest influence? What's the biggest impact on gold? We will cover this in commodities, but I'll sorry?
Oil?
No, good try.
Supply, because money decreased.
It's
demand, sorry, not supply, demand.
It's the US dollar. The biggest impact on gold is the US dollar, okay? Because gold is traded against the US dollar. So, in the heart of the crisis, when the dollar is rising, what would you expect to see gold doing?
Decreasing.
You'd expect to see gold rising because it's a safe haven, right? But if you know that the biggest influence on gold is the US dollar, what would you expect to see the gold doing? Hint, it's the opposite to what you think.
Fall.
Falling. So a lot of clients were contacting me about this at the time. What's going on with gold? I don't understand what's going on with gold. So you can see here the heart of the crisis when we saw that strong dollar demand. Can you see here gold sinking? Can you all see that on your screens? This is the spot gold chart, and gold was sinking during that time because yes, gold is a safe haven currency, a safe haven commodity, but the biggest impact on gold is the US dollar. So in the heart of the crisis, we had gold falling heavily. Now, no one was expecting those falls to continue because the fundamental outlook for gold is very strong. We'll touch on that when we look at commodities, but that's a key kind of indicator. And I'll tell you one of the ways that I practically trade gold at the moment, you might find this interesting, is I will look at the equity markets, because what you see is that as equity markets fall, gold falls. As equity markets rise, gold rises. So gold is trading at the moment as a risk-on commodity during this crisis because of the impact of the dollar. The dollar has become like a safe haven during this crisis. Now, as we're speaking, in the last couple of weeks, we're starting to see some of that relationship break down. So at some point, the dollar is going to flip back to its normal action. But during the COVID-19 crisis, it's been behaving as a safe haven. So if I now put the dollar index chart on this, you'll see, lo and behold, as the dollar rises, gold falls. As the dollar falls, gold rises. You can see here, rising dollar, falling gold. Falling dollar, rising gold. So I didn't catch the name of the student that asked that question about gold, but does that answer your question?
Yes, it does. Thank you.
No, thank you. It's a great question, and it's not what you expect, is it?
No, because I thought nowadays people would trust gold even more.
Well, you're right, they do. But remember, when we started this presentation, it's a dollar-centric world. Don't underestimate the US dollar. And remember, where the Federal Reserve go, the rest of the world follow. The whole financial market is really geared around the US. They've managed to do a fantastic job of making sure all the cards have been dealt in their favor. And we live in this dollar-centric world.
I've got one question.
Yes.
When it comes to, I'm not really sure if it's related, but it's been used quite frequently recently. The VIX, the VIX.
Yes.
To measure volatility.
Yeah.
That one hasn't increased as much as I was expecting it to. Why would you say that? Why do you think that happened?
It hasn't. Well, it's rising at the moment because of the election risk. So if you have a look here, that is the gold VIX chart. And what you notice, and this, Alex, is interesting because this is what I was looking at for buying gold at the time. Because when this was all happening, if you go back to 2008 and 2009, you will see that we had a very similar reaction. Let's see if I'm hoping that will. Right, the volatility is not coming up on this chart, but you'll just have to take my word for this, Alex, that in 2008, 2009, do you see, oh, here it comes. Do you see how we had this very similar reaction? That as gold was falling at the start of the crisis, again, the dollar was being bought. Do you see how the volatility shot higher?
Yeah, I can see that.
So when volatility shoots higher, that's negative for gold. So one trigger that I was looking for to buy gold, because 2008, 2009, very similar financial situation, central banks cutting interest rates, lots of quantitative easing, low interest rates for years, fantastic opportunities for gold buyers. I thought, okay, when the volatility went underneath about 30, that was a time where gold buyers would step back in. So Alex, that is one indicator that I look at in order to think, oh, hang on, when's a good time for buying back into gold? But you can see volatility is rising again, and we've got volatility. If you just go to the 30-minute chart, you can see that volatility is sort of picking up a little bit at the moment. It's a bit messy. Does that roughly answer your question, Alex?
Yes, thank you.
Yeah, you're welcome. You're welcome. Right, we're going to move on because we've got plenty to say. It's amazing. When we get talking, there's so much to talk about. Thank you for your questions. They're very good. They're very engaging. So thank you for engaging with this. So the other key aspect that's been driving FX, it's not just the fact that the FX world is dollar-centric. Of course, the role of central banks come into the world and their monetary policy. Okay, so you understand what monetary policy is. I know that. I've taken these slides from a different presentation, but very crudely put, the central bank's monetary policy just moves the currency like an engine moves a car. So central banks around the world, they started changing their monetary policy in response to the reduced consumption that was coming about due to COVID-19. And a number of central banks, what action do you think central banks would have taken during this COVID-19 crisis in order to help companies? What kind of monetary policy moves do you think they would have done?
Perhaps lower interest rate.
Exactly. Now, for me as an FX trader, that is what I am focused on. I am forever studying central bank's monetary policy, and I want to see whether a central bank is going to be cutting interest rates, raising interest rates, or keeping them the same. That's what I'm always looking at, because when an interest rate rises, I know the currency is going to appreciate and vice versa. So as a currency trader, that is a key thing for me to be looking at. And I'm going to show you some of the central banks' movements. So central banks around the world started cutting interest rates. And of course, if you remember the story of the Pied Piper, the Pied Piper plays the tune and all the mice follow. The Federal Reserve is a bit like the Pied Piper of the central bank's world. So once the Federal Reserve started cutting interest rates, central banks around the world followed. Central banks' interest rates are now very low. Some central banks have negative interest rates. So the Swiss National Bank have negative interest rates, the ECB, the Bank of Japan, and the RBNZ, New Zealand Central Bank, is talking about potentially cutting interest rates as well. So this was one of the impacts. Now, of this. So when the Bank of Canada cut interest rates, now this will give you an insight for trading. If a central bank does a surprise interest rate cut, will that have more impact on a currency than if it announces or flags a currency interest rate cut weeks in advance? Which one will have the most impact? A surprise, or if it does it by announcing it in advance?
When it's a
Surprise.
surprise.
I think when it's
Yeah, exactly. It's a surprise. We all know that, don't we? And for me as a currency trader, they are the kind of opportunities that give the best opportunities because the markets tend to move in one direction more consistently. So this was the Canadian dollar yen, and this was around March. So this is around the height of the crisis. The Bank of Canada cut interest rates 50 basis points. So we saw the Canadian dollar was losing value. The Japanese yen was gaining value because of the COVID-19 inflows. Yen is a risk currency. So you can see, oh, look, there's reasons for CAD weakness. There's reasons for yen strength. So you compare these currencies together in order to, be more sure of the currency direction. So I'm very sorry if this is offensive to you to see a currency trader in action, but this is how my business works. Similarly, this was, so these charts here, these are actual trades that I took on my account. So you see the red arrow is where I entered, the red arrow is where I exited. And so these are actual trades that I took at the time. So I thought it'd be more interesting to see how I practically did that. Similarly, this was saying the CAD Swiss franc. The Swiss franc as well gains value in a risk-off environment when markets are concerned. The Swiss franc is seen as a very stable currency. Investors like to have Swiss franc. It annoys the Swiss National Bank something crazy, and it hurts their export economy. So that's why they intervened to try to limit the weakness in the Swiss franc. But that was another impact there. Then we had buying gold. Now, I think it might have been Grace who asked a question about the Federal Reserve and gold being a safe haven. Now, why did I buy gold when the Federal Reserve cut interest rates by 50 basis points?
to sell it back later.
Say that again.
To sell it back later when it increases.
Good attempt. It's not that. If a country cuts its interest rate, what happens to the currency?
Currency will fall.
Inflation.
Yeah, the currency will fall. Correct. So, what's the biggest influence on gold?
The US dollar.
US dollar.
US dollar. Now, do you see why I bought gold on US dollar weakness? So when the Fed cut interest rates, you knew that gold was going to rise. Okay, and see that this is a trade that I took on my gold chart. And I also took one on silver for exactly the same reasons. Exactly the same, because of the Federal Reserve rate cut. So one of the key impacts of COVID-19 has been central banks cutting interest rates. Now, what problem do central banks now have, and what problem am I grappling with now, trying to understand what's going to move currencies in the future? Because I have a problem now, and what problem is that? And it's something due to what the central banks have done.
Most of the interest rates are very low, so now you're not really sure which one should you buy.
Alex, exactly. So now I think, well, interest rates are very low. So what solution might I have, Alex?
Maybe check the news, see which one's going to perform better.
It's a very unfair question of me to ask you, Alex. Thank you very much for answering. I don't know either, if that's any help. I'll tell you one thing I am looking at, though. I am looking at government's debt to GDP ratio. So if you look here, I'm looking, well, which countries are in the most debt? Because the countries in the most debt are going to find it hardest to give fiscal stimulus to their economies. So if you're in a lot of debt, you're limited to what you can do. So okay, here in the UK, our debt to GDP ratio is now over 100%. So that's very high for us. We're not used to that level of debt. The last time we had that level of debt was in the world wars. So it means it limits the level of fiscal stimulus that we can inject into the economy to support it. So what I'm looking at now is which countries have a low debt to GDP ratio. They're the ones that are best suited to get out of the crisis. So, you know, looking at Australia. Okay, Australia's debt to GDP ratio, pretty good, isn't it? What is it, about 60%, 70%? They also have contained COVID-19 pretty well. So you think, oh, okay, look, Australia's currency still stands to increase. And particularly with other reasons as well, with China showing a rebound from the slump that we've had due to COVID-19. China and Australia's economy are very linked. About 30% of Australia's GDP comes from its trade with China. So Australia is really well placed to recover going forward.
But then,
so that's one of the things that. So that's basically some of the main problems here that currency traders are facing at the moment. Hang on, sorry, something's happening with my screen. That's okay. That's better. Now, what impact do you think this whole crisis would have had on the bond market? And there's been a strong impact on the bond market. What would investors want to do in times of crisis? Will they want risky investments or safe investments?
I think they would want to invest more on US Treasury bills in this time.
Bonds are one of the safer forms of investment. So
invest more on bonds.
Say that again, sorry?
Invest more on bonds because they're safer than stocks.
Exactly. So if the bond market is rising, what happens to bond yields?
Low.
Yields go down.
Yields go down. Well done. Oh, it's nice to speak to people who understand that. It really is. Now.
But they'll be looking into getting bonds which are more short-term than long-term ones, right? And then that could potentially mean that the long-term ones would increase their yield even more.
Yes, so there'll be a rush. There was just a rush generally to the bond market. So if you look at 10-year government bonds here, you can see these yields falling. So the yields, I'm just going to move this. There we go. You can see the yield now is down to 0.78% for a 10-year bond. So that's, that's very, very poor, a very poor return for, a 10-year bond. And you can see like 2019, going into the crisis, you can see, look, you could get 2.83% return for a 10-year bond, which that's not too bad. But now it's 0.78% because bonds have been bought up so heavily. So that US 10-year bonds was repeated around the world. So bond yields have all been plummeting as investors were rushing into bonds. Now, an interesting sort of story that I was following at the start of the year was this, and I'm going to show you what it was. You've got the idea that basically bond investors tend to be more risk adverse than equity investors. Now, bond traders, they tend to trade in a much more stable way. So they look sort of 6 months, 9 months in advance. They're very, very risk averse. So you can see here, you've got the 10-year bond and you've got equity markets. And at the start of the year, there was a question that was going around the markets, which is this: bond traders are seeing trouble ahead, but equity traders are still buying. Now, usually yields and equity markets move together. But at the start of the year, there was a divergence. You saw bond yields falling. So market participants were worried, but yet you saw equity markets rising. And so the question is, which one's correct? Now, the general rule of thumb that I use in trading is when I see a divergence between the bond market and the equity market, I tend to go with the bond traders, because the bond traders, they're looking 6 months, 9 months, a year in advance. They're more stable in their outlook. The equity traders can be much more sensitive to risk. So they can be moving in and out in a much quicker way. So the bond trader tends to have that more longer term outlook. So one of the interesting moves at the start of the year was how the bond yields traders were seeing trouble ahead. And so that divergence in equity markets and bond yield traders showed that the bond traders were correct. And then we saw this huge drop in the S&P 500. So that was another key, key market move at the start of the year. Okay, so in a moment, we're going to go on to impact on the commodity markets. Any questions that you have at this stage?
Majid has one question. Majid, can you please ask your question?
Yes, so I wanted to ask about the reaction of the Russian ruble against when it was announced that they produced the vaccine, the Russian vaccine. And what's the expected reaction of the currency of a country who produced like an approved vaccine against COVID that everyone trusts?
Yes. Majid, very good. The ruble is a petrocurrency. So one of the big drivers of the Russian ruble, as well as monetary policy, is also oil markets. So the ruble obviously was pressured with the fall in oil markets, which we'll get onto at the moment. And also the fact that Russia announced the vaccine, the market's reaction was one of skepticism, because as you can imagine, if a Western country says they found a vaccine, they will be much more rigorous in their testing. And even the fact that we're getting vaccines this quickly is unheard of. So the fact that the Russians were able to come up with a vaccine much more quickly than everyone else, the market was quite skeptical about the validity of those claims, and whether that actually, who would want to take a vaccine that the Russians said is, okay. It would be very unpopular, because the Russians, they've got a reputation, they're hardcore, Russian hardcore, they're very strong, and they might not look at all the regulations that need to be covered. So Majid, it was skepticism. The markets certainly weren't responding strongly. However, AstraZeneca, some of their positive results, Pfizer, their positive results, the anticipation is that a vaccine will be found. So if we looked at the S&P 500 and we saw this, didn't we? We saw a dip and we saw a recovery. And remember, investors are trying to look ahead always, okay? So part of my role in the job that I do is I'm not looking at what's happening now. I want to know what's going to happen in 6 weeks' time, 3 months' time, a year's time. So that's the key thing to get your head around, Majid, is that a vaccine is now expected. Now, once the vaccine is authorized, can be rolled out, you would anticipate a strong rise in risk markets. So you expect the S&P 500 to rise. You'd expect gold to rocket higher. I expect the US dollar to weaken. I'd expect to see the NASDAQ shooting higher. I'd expect to see global indices up. I'd expect to see bond yields rising. I'd expect to see copper up. I'd expect to see oil up. I'd expect to see all markets going heavily risk on once the vaccine is approved and can be rolled out. So that's the impact that I would say. But one fact I would have to say, Majid, is that if the market keeps expecting it, and eventually it won't move by the news, if that makes sense. Think of it like this. Imagine if I said to you, Majid, you know, I want you to come to my house and we're going to have a great time. We go out for a lovely restaurant. We're going to go out to a theme park. We're going to have a great day. Now, if I tell you that first time, you're going to be really excited. But if I tell you that 20 times before you come over, by the time you come over, you probably wouldn't be that excited. It's very similar to the markets. The more the market anticipates something, the less of a reaction that you get. So we're in this kind of borderline stage now where you can see the S&P 500. Can you see this chart?
Yes.
You see the drop?
Yes.
And you see the rise?
Yes.
Right, the rise is on the fact that a vaccine's coming.
Oh, okay. So that's an anticipation.
That's anticipation. Traders always trade in anticipating. Like to help you understand, at the moment, the oil market is pressured, okay? So OPEC Plus have said that they will reverse production cuts in January. Now, I don't think they're going to reverse production cuts in January because COVID-19 cases are rising. So I'm thinking now, 2 or 3 months in advance, what they're going to do in January. Does that make sense?
Yes.
Yeah. And that's the way that investors think. They don't think, oh, today's the news out, oh, therefore I respond. Because that is usually too late. And often investors do the exact opposite. Because say, for example, you're anticipating a vaccine, and say you've been anticipating it for 6 months. Then when the vaccine's announced, what might you do? You might close your positions. Because there's nothing new, is there? There's no new news. It's like next week, the Reserve Bank of Australia expected to cut interest rates. Now, am I going to wait until then to put a position on if I'm going to trade that event? No, not necessarily. I'll be trying to do it beforehand. And then when the event happens, then you can close your position.
So you're trying to get 2 steps ahead.
You've got it, Majid. It's always 2 steps ahead. Exactly. And that's a good way of putting it. So you can see here, during COVID-19, equity traders are trying to get, and I like your term, Majid, it's better than 1 step ahead, 2 steps ahead, because that does kind of sum it up. They're 2 steps ahead. Do you see?
Yes, I've seen that.
But what you're saying is still valid. There still could be some more upside. So it's a bit unknown. I had to explain it that way so you can understand the investor trading mindset.
Yeah, I understood.
Good. Good, very good.
Thank you.
I've got a question, maybe unrelated. You as an investor, would you discuss with other investors and be like, yeah, what do you think is going to happen with this one? Okay, everyone, do you think we should buy it? Or it's more of an individual stuff decision, if it makes sense?
Alex, I'm an analyst, so I read other people all day long. I read this report, I read that report, and some of my colleagues will specialize, and my friends will specialize in an area. So I have a friend who specializes in cryptocurrency. So just a couple of weeks ago, I was looking at a report. I thought, oh, I found that really compelling for some upside in cryptocurrency. I said, what do you think of this? And then he gave me his view on it. So I personally, if I knew someone knows a lot about a field, I like to get their view. Usually I've already formed my view, but I just want to think, well, do they have anything extra to say? Or is there an alarm bell that I haven't thought of that they maybe know? Maybe they're an expert in the oil market. And I touch on the oil market, but I'm not in it every single day. So yeah, I will definitely do that, Alex. Now, some investors might not, but I like to do that because I like people. I like to have a conversation as well. So it gives me an excuse to ring a friend. Yeah.
Thank you. Thank you.
You're welcome.
I wanted to ask about the airline industry because right now it's quite low, and a lot of smaller companies had to close and let go of most of their staff and crew. But if a vaccine comes out would you expect the stocks to skyrocket again, or even hit at the height they were at prior to the coronavirus?
Yes, airlines. Okay, so in terms of consumption, once COVID-19 is kind of behind us, tourism should pick up, shouldn't it? Because that should go back to pre-COVID-19 levels. You'd also expect to see some business travel pick up. But one wider question that I have is how much business travel are we going to go back to? Because look, what would I have done before COVID-19? If I was going to speak to you, what would I have done?
You would have had to travel there.
I would have traveled there. So I come to Dubai about 5 times a year. So I would have probably tagged it onto one of my trips and I would have met you in person. Now that's more pleasant for me because I get to spend some time with you face to face, which is much more pleasant, but we can still do things over the line. So I haven't got to take a trip over to Dubai, be away from my family. So I think some business travel is going to be cut permanently. So the airlines, some airlines are going to struggle to come back up to previous levels, in my opinion. So I think they will return. So the well-capitalized airlines, and they could potentially offer medium-term value because their stock prices are very depressed. But some of the smaller airlines might be taken up by mergers. I think Cathay Pacific, they had a merger recently. I'd expect some other airlines to merge as well. That's a non-answer answer to your question. Is that okay?
That's all right. But I also wanted to see if what were your thoughts about these big airlines such as Emirates or Lufthansa, or do you believe they would pick up more, or rather their low-fare carriers, because people will maybe not want to spend that much money to still travel, like for instance, inter-European flights or in the States? Which companies do you believe will pick up more or quicker?
That's an interesting question. I think the first thing I'd like to look at is the routes of the airlines. So where are their main routes? Are there routes to countries which have got large restrictions, or are they domestically based airline companies? So if you get a domestic based company that has lots of domestic routes, that would be positive. So China, for instance, if you've got some airlines within China that are then just flying within China, that's good. So I'd expect those airlines to pick up quicker. You'd also need to look at the capitalization and the cash burn. So how much cash are they burning per day just to keep their fleet in place? And how long can they keep that cash burn going? So you'd be getting into quite specific detail about the internal market dynamics of each individual airline. So I'm not an expert on airline stocks, but they were some of the issues you'd be looking at. How much is business travel? How much is tourism? Where are their routes? What's their market capitalization? What's their local competitors? Does that seem a reasonable answer?
Yes, thank you very much.
No, you're very welcome. But that's the kind of detail that investors will go into in order to identify a potential investment. Or the other thing is to invest in airline ETF. So a broad index that represents the airline sector. And that way you don't have to pick and choose a winner. Does that make sense? Yeah?
Yes, thank you.
Yeah, you're welcome.
I'll ask a question.
Yes.
Good afternoon. So I just wanted to pick your brain and say, for a lot of companies, COVID-19 was sort of a good thing, because a lot of people say that, people on the train, there were a lot of people on the train, and COVID-19 shook a lot of the people off the train, and the people that remained on there were stronger. So do you think COVID-19 was a good thing in terms of the market, as call it a reset for the world?
Is it Alexi?
Yes.
Alexi, yeah, that's a great question. I don't think the train's been shaken. I think all that's actually been done, if you look at the amount of stimulus that's gone on around the world, the stimulus packages are huge and unprecedented. And if you had to summarize it, 2008, 2009, some companies were considered too big to fail. The problem we've had in this crisis is there's too many to fail. So the banks were bailed out in 2008, 2009, but now literally everyone's being bailed out and countries have taken on extra debt in order to do it. That means some zombie companies have been supported through this.
Okay.
So the time we might start to see people falling off the train will be when the stimulus ends.
Okay.
Now, looking at the size of the stimulus packages that are being released, the US, you know, they're talking about a $2 trillion package. They're really supporting the US companies and US consumers, and there's not going to be many losers in that. So the reality is that many people have been supported, and if I'm honest, Alexia, I'm happier for that, because if the market was just left to have its cold hard dynamics, you'd be looking at 20–30% unemployment. You'd be having civil unrest. You would be having severe strain on infrastructure and you know, peaceful democracies. So I'm pleased that the support has been there, but if, you know, the support has been very generous, and that means some markets that don't necessarily turn a profit are still allowed to carry on. And, you know, I leave that to other people to really assess. That doesn't seem right to me, that you can have companies that are just have no chance of turning a profit, but yet have strong capitalization and can keep making no profit year after year.
Okay. Thank you for that.
No, you're welcome. I'm going to jump on with the seminar because we've been enjoying ourselves too much. So we need to get on and do some more work. Okay, so impact on the commodity markets. So one of the big impacts on the commodity markets was gold. Now, gold, I'm expecting a lot of strength in gold. So this was the heart of the crisis. We had gold falling. These were 3 trades that I took in gold because I was convinced that the upside for gold was looking very good. Now, gold tends to do well in a low interest rate environment. One of the downsides of holding gold is if you hold it physically, you have to pay a storage cost. It has no dividend. So unlike a share, if you hold gold, you don't get a certain percentage for holding it each year. It's generally unattractive. However, when interest rates are so low, and in fact, interest rates are actually negative when you take inflation into account. So that means that interest rates at the moment, I think if you bought a 10-year bond, the interest rate is something like minus 1.3%. So you stand to lose 1.3% of your investment when you take inflation into account. So bonds are actually returning negative yields over time. So what do investors want? They want return for their capital. Now, interest rates are expected to remain low. The Federal Reserve said at their last meeting that interest rates are expected to stay low until 2023. So we know the US dollar should be weak for the medium term. All of this supports gold. So once volatility had dropped down, I was looking to buying gold, and the gold upside we've seen, that was just how I took a trade based on some technical pattern, which I won't go into now because we haven't got time. But I'll show you the gold market. And you can just see here, this strong move higher in gold. Do you see how it moved up to record highs around 2080? And the upside for gold is still in play. So most market analysts are still bullish on gold. So that was one of the reactions. And of course, if you go back to 2000, 2008, 2009. Do you see how we're having a very similar reaction? We saw market participants, low interest rates, quantitative easing, and between 2009 and 2011, gold had this strong run. We're in virtually identical economic conditions today. Low interest rates, central banks having lots of quantitative easing, so very positive for gold. Now, myself, I'm just looking for, nice clean trend line break, and you'd anticipate gold moving higher. The one fly in the ointment of this outlook at the moment is the US election, which means there could be some volatility ahead. But that was one thing, gold. Now, oil, what we expect to happen to the oil markets? This is the oil chart. Okay, disclaimer, we'd expect the oil markets to fall because people aren't traveling. Airfare is the biggest consumption of the oil markets. So planes aren't flying, diggers aren't digging, people aren't traveling. So there was a huge drop in oil demand, and you can see that oil actually went negative. So in the futures markets, people were actually paying you to take gold off their hands. Because if you're going to take physical delivery of oil in the futures markets, you don't want physical delivery of a commodity you can't sell. So oil markets actually went negative on the futures contracts, which many people didn't even think was possible, but it is. So we've seen this huge drop in oil prices, and we're seeing a little bit of a recovery at the moment. And of course, this is going back to Majid. If tomorrow the markets suddenly say, Pfizer says, we found a vaccine really successful and we reckon we can roll it out to the world by January next year, then oil markets would just rip higher. Because, oh great, airlines will start moving again, cars will start moving again, everything's going to be back to normal. So at the moment, we've got this indecision. I won't go into the reasons for the indecision. We're just looking at the broad impact of COVID-19. Okay. Now, the other commodity we're going to look at is copper. Now, one of the nicknames of copper is Dr. Copper. And Dr. Copper is called Dr. Copper because it tells you what the health of the global economy is like. Copper is a commodity that's crucial for construction, houses, wiring, and of course, with green technology increasing, all conductive materials need copper. So copper is seen as the global kind of litmus test of how the globe is doing. So what do we think happened to copper during COVID-19?
Sharp fall?
Yes, we did expect, exactly. And then do we expect it to fall and keep falling, or do we expect it to start rising?
Rising because we're anticipating a potential vaccine.
Exactly. So that's exactly what we saw. So we saw copper prices fall heavily, and then we saw them rising. Now, copper is also getting some extra boost because with all the green technology that's expected to come, people are thinking, well, hang on, people are going to need more copper in the future because of all the electric vehicles. So copper's got that supportive narrative driving it. Also, where do you get copper from? Where does copper come from?
You have to mine it.
Yes. And if you're mining it, obviously it's people that mine it. And the biggest copper mines are in Peru and Chile. And where are some of the highest COVID-19 cases?
South America.
South America. So what do the miners do when they got COVID-19? Do they all go and work together? Not necessarily, do they?
Probably not.
Probably not, exactly. So all of a sudden, the mine production is reduced. And so if you reduce supply, but the demand is still there, what happens to the price?
Price goes up.
Price goes up. So that's another driver of copper prices. So that's the sort of thing that I'm looking at on a weekly basis. What's the copper demand? What's going on in the mines in Peru and Chile? Like recently, there's been some potential strikes over working conditions and pay. And so the question is that going to hit supply production? And so prices have been moved around by those big narratives. But the big narrative, copper dropped, and then it rose again on the expectations of a swift, sharp recovery. Now, one of the difficulties you have in trading is this all looks very obvious in hindsight, doesn't it? Oh, you saw a drop and a rise. Yeah. Trading at real term is totally different. So when those copper prices fell and when the S&P 500 fell, the majority of analysts that I were reading were predicting those falls to continue. So this V-shaped recovery was spoken about by a number of analysts. They were expecting a V-shaped recovery, but not everyone was expecting that at all. And it still remains to be seen whether this V kind of shape maintains going forward. Just going to go back to the main presentation. So that was just a technical trade I took on gold, a different reason I told you I was convinced at buying gold, so I bought into that gold market there. I won't go into the ways I did it. I bought into silver. Silver tends to follow gold, but it lags gold. So if gold moves a long way, silver tends to play catch up. So in the COVID-19 crisis, you have gold move first. And then when I saw gold move, I thought, well, hang on, silver will catch up its big brother. So I went long buying silver, and it was a great trade that I took at the time. So I'm going to congratulate myself. Well done. But I took my profit far too early. So that still haunts me. Okay. So any question and answers on commodities?
How have the blue chip future commodities been affected by COVID?
So again, futures markets, the gold futures markets are anticipating higher prices. So I was looking at the futures markets in gold, the contracts all the way out through to next year. And they're expecting prices to rise higher all of next year. I haven't looked at the future contracts for much longer for the other commodities, but copper prices are expected to rise higher as well. But I'm not sure about the oil markets. I just haven't looked at it.
Good afternoon.
Is that okay, Grace?
Yes, thank you.
I have a question.
Yes, Yusuf.
Yes, good afternoon.
Good afternoon.
Thank you for your very interesting and informative talk so far. I just have a simple question. I noticed in many, if we can call them poor or countries like India and those countries, they prefer to buy gold over investing in anything else. Is it because they are worried that their currency is going to fall, or what could it be?
Okay, I've got a ring on my hand, Yusuf.
Yes.
Now, this is Western gold. Now, Western gold, I'm sad to say, is poor quality. Now, I'm a man and I clunk around. So I got 9-carat gold wedding ring because I knew if I got a better quality gold ring, it would be crushed within a week. So I got a hard gold, but it's only 9-carat. Now, if you go to the Far East, say Hong Kong, and when you buy gold there, the gold you get there is what's called 4 nines, 99.99%. It's the highest quality gold you can get. And it's much easier to trade gold in the Far East because it's a store of value, Yusuf. You're absolutely right. if your currency might fluctuate 10, 20, 30% in a couple of weeks, what do you want to have your money in? A commodity, or do you want to have it in your own currency? You want to have it in a commodity, don't you?
Yes, of
So
course.
gold has that store of value. So the further east you go, the better quality of gold you get. Like this is probably as much copper as it is gold. Whereas in the east, you have that higher quality of gold because traditionally it's seen as that store of value for the reasons you've outlined. And of course, India and China are the two biggest gold purchasers. So between the two of them, gold tends to rise in January because of the China Lunar New Year. Investors and Chinese nationals buy gold in anticipation of the gifts. Diwali comes up mid-November. So gold, I was anticipating gold prices rising a little bit for Diwali. For India purchases, you also get gold tends to rise in August for the Indian wedding season. So you're absolutely right. It's because of that store of value. And that's why gold, the markets tend to be a little bit more liquid in the further east you go as well, for exactly those reasons. Now, during the COVID-19 crisis, what has happened to jewelry demand, do we think?
It went down.
But what replaced it?
I'm not sure, actually. Thank you for answering my question.
Yusuf, is absolutely fine. What replaced it was gold ETF purchases. So exchange traded funds was a product that the Gold Council really got going to encourage extra investment. So the ETFs have been at record levels over the financial crisis because people want to put their money into gold. As soon as we get a vaccine, say we got a vaccine about November time, December, I would anticipate gold to have a really strong year end in anticipation of the Chinese Lunar New Year. So that's one area that I'm looking at quite carefully, Yusuf. Does that make sense?
Yes, it surely does. Thank you very much.
No, you're very welcome. But that's the key. It's the quality of the gold. And you're absolutely right to make that observation. So well done. Okay, very briefly, we'll look at the impact on the major indices. So we've covered a lot of this already, but it will be as we'd expect. So S&P 500 dropped and recovered. The ASX 200 dropped and has shown some pretty strong recovery. The DAX, again, the major indices around the world have shown this V-shaped recovery. So that's the Dow Jones. So that V-shaped recovery. This is the DAX. See the V-shaped recovery. Euro stocks, ASX 200, very similar. Now, a couple of questions for you. Now, the NASDAQ, it's more like a Nike tick, isn't it? See, it's more like a tick. Why has the NASDAQ had that kind of response? Why has it been bought so strongly during the crisis?
Was it because gold was going, I'm sorry, the dollar was going up at the time?
Good guess, Alex. It's not that. What's the NASDAQ composed of?
It's composed of
technological companies
that are deemed as safe due to the current situation.
Mohammed, exactly. What it is the NASDAQ is primarily known as the tech stocks. So it has a bias towards tech stocks. And these were known as the stay-at-home stocks. Facebook, Amazon, Google, Netflix. So during the COVID-19 crisis, those earnings from those companies helped lifted not only the NASDAQ, but also all of US stocks. Now, what you have to remember with the NASDAQ is that like Facebook, Apple, Amazon, and Google make up 30% of the weighting of the NASDAQ. So you see how only those 4-5 companies have an adverse proportional reaction on the index. And I think those companies make up about 15% of the S&P 500. So it's, you know, very skewed to some, you know, really big companies. And of course, at the moment, we've got earnings season coming out. So we've got like Facebook, Google, Amazon, and one other. They've got their earnings on Thursday. So that's part of the reason why we saw the NASDAQ rise higher. And at the time, it was called the stay-at-home stocks. Everyone's at home, ordering things off Amazon, watching things on Netflix, and searching for things on Google. So it was a good business time for them.
I've got a question. They were talking about a tech bubble at some point.
Yeah.
How, I mean, basically that, how do you know when the stock is overpriced, and how do you know when to basically close your position?
Yeah, it's a very good question, Alex. And there isn't an easy answer. How do you spot a bubble? So I'll show you a bubble, and I'll show you I'll show you my answer for it. And it's something that I've just picked up from experience. So when you look at Bitcoin, okay, now this had a big bubble going back into the Christmas of 2017, 2018. What you saw was that it was a kind of seen as a bit of a millennial thing. It was outside the realm of traditional investors, essentially. It was a little bit fringe. Now that's changing a bit now, but I'm not going to get into that. But let's just go back to the bubble we saw. Now, a good rule of thumb is when you start seeing news everywhere about the same thing. So I'm an analyst and I look at news reports. So when I see everyone talking about buy this, buy, that is sometimes a good sign for me that the market is overbought. It's a little bit like if my postman came and told me that I should buy Bitcoin, that's when I know I'm in a bubble, okay? Now, it's a silly thing, but it's true. If you have a wide spread of a popularity for a stock or for a commodity, and everyone's talking about it, eventually it becomes overbought. So in answer, there's no sure way to know you're in a bubble, Alex, until the bubbles burst.
I understand. Thank you.
Now that's just from my trading, from a trading perspective. The way I get around that is that I limit and I define my risk. So I'll show you how I do that. I bought Bitcoin recently because of the fundamental bias for Bitcoin, and this is how I entered the trade. I had a strong bias to buy Bitcoin. When Bitcoin broke through this trend line, I bought Bitcoin. I have my stop running here at around 8,500. Okay, so if all goes wrong, I would get out at 8,500. But in reality, if price goes back below this trend line, I would exit the trade. So that's one of the skills that I use to limit my risk, which is one of my top priorities. I'm sure your professor will have a better explanation how to spot a bubble. There we go.
I have a question regarding Bitcoin.
Yes, yeah, Mohammed, fine.
So for example, for equities or for commodities, the price is based on an intrinsic value. However, that is not the case with Bitcoin. So what is the determinant of the price?
Okay, so again, with Bitcoin at the moment, it's still a little bit controversial, but I'll tell you what's driving it higher at the moment, and it's nothing more complicated than the fact that things like PayPal have said that their users can start using Bitcoin. So they said that last week. A few big companies have put their huge sums of money into Bitcoin. You have like big hedge fund manager Paul Tudor Jones. He's been saying he sees tremendous upside for Bitcoin. You've had central banks around the world looking at digital currencies. You had Facebook, who were looking at monetizing their user base through a currency called Libra. You have the fact that sort of I don't understand exactly how the mining works, but there's a limited 21 million Bitcoins that can be in circulation, so the supply is limited. So there's some of the reasons that some investors see opportunities for Bitcoin. And I guess in a way, what we've seen is that we've seen a digital acceleration, haven't we, over the last 6-9 months? And I guess a logical extension of that digital acceleration is a digital currency. So it stands to reason that Bitcoin would grow. Some people see Bitcoin as a digital gold. And sometimes gold does operate and track gold very closely because of its close link to the US dollar, obviously. So there's some of the reasons that people perceive value in Bitcoin. And there is still controversy over whether it's a fiat currency, not whether it's a fiat currency, what's its intrinsic value. But I'll tell you an observation that I've seen. In the last couple of weeks, I've seen reports from Morgan Stanley, Bloomberg Intelligence, and Paul Tudor Jones all talking about Bitcoin. Now that would have been unheard of a year ago, 2 years ago, it would have been unheard of. And you also got PayPal legitimizing it for its users, whereas usually previously you hear Bitcoin in the same sentence as terrorist and criminal. So there's been a social shift as much as anything, Mohammed, that I'm noticing. Does that answer some of your question?
Yes, it does. Thank you.
Yeah, you're welcome. You're welcome.
I have a quick question regarding cryptocurrency.
Yes.
And so with over 2,000 cryptocurrencies right now available on the online market,
yes,
how difficult it is to choose a certain type of cryptocurrency to invest in, like nowadays?
Yeah, and this is very difficult, and I wouldn't bother trying myself. So I bought Bitcoin because it's the one I've heard of. I'm not going to go in Monero or Zcash or Litecoin. I haven't got a clue about any of those. I don't really fully understand Bitcoin. But my role as a trader is understanding enough to know, I can trade it. So for myself, which is the king of the Bitcoins, of the cryptocurrencies? It's Bitcoin. So you would have to be a specialist, Anas, in cryptocurrencies to know the difference between them all. You'd have to study it carefully.
Okay, makes sense. Thank you.
And the thing is, like, one of the rules I have for investment is, if in doubt, stay out. So I wouldn't just invest if someone, I got an email saying, oh wow, Monero is the next best cryptocurrency. I wouldn't just, oh wow, it must be. Okay. I have to have an interview with CNBC in a few minutes. So I just want to quickly go through the end of my presentation. So I'm going to have to cut questions a little bit short there. That I have to say, I have enjoyed all your questions very much, and thank you for engaging so well with me and listening so well. It's been I've really enjoyed this time. So what's next? Obviously, US polls. So I just wanted to say we've got a US election coming up next week. So financial markets are laser focused now on what happens with the US election. And basically, if Biden has the victory, that's expected to be the most optimistic for stocks. So the closer it gets between Biden and Trump in the polls, the more risk averse the market's going to become. So at the moment, we're starting to see a little bit of nervousness just entering in the markets as it's waiting for the elections next week. 2016, there was a surprise result, took a lot of people by surprise. So many market participants, they remember that, and so they're just de-risking ahead of the main event. In terms of a little bit more about myself, if ever you want to read my blog, you can read my blog here. I've got a Twitter handle, which I give, market news. I've got a LinkedIn profile, and I also have a trader training program that I run there. So if any of that is of any interest to any of you, I'll just leave that up there so that you guys can see the information. And you can contact me, any questions, you can speak to your professor. If there's any questions that you have after the webinar that you thought, oh, gosh, I wish I'd asked, please speak to Professor Budger and she will contact me, and it's been a pleasure, everybody. So thank you very much for having me during this time. I'll leave you to the sunshine in Dubai. I will go back to my rain.
Okay. Thanks, Giles. Thanks a lot. It was very inspiring, very informative. I hope we can host you again.
Oh, it would be my pleasure with such a lovely group of students.
Yeah, they enjoy a lot. Thank